I'm Joshua Snell, and this is my weekly report on projected interest rates from August 15th to the 19th. The opening of the week was greeted with a fall in the stock market. Dow Jones, S&P 500, and the NASDAQ Composite all fell over 30 points for the day. Gold had a major surprise, which had the biggest single-day decline since 1983. Also, oil and other commodities fell due to slowing economic growth in China. China reported a 7.7% gross domestic product, which is lower than the 8% projected. Since China is a major buyer in commodities, this has worried investors because commodity prices are projected to fall. This has made investors seek liquidity in the market by selling off commodities and other stocks and equities and buying more bonds, which, as you can see in the graph, there's a dip in the 10-year interest rates. This is due to the Federal Reserve keeping interest rates low for the 10-year mark for mortgages. Back in 2008, mortgages were defaulting, and the Federal Reserve decided to keep 10-year interest rates low in order to keep mortgages. Also, the VIX, which measures volatility and specifically tells you the expected movement of the S&P 500 index over the next 30 days, was higher. More volatility was seen in the market due to more active trading. Tuesday, you can look at the graph and it looks like there's no obvious effects from Monday because the change is very minor. Although hard to see, projected interest rates fell Tuesday on average, which you'll see later. Wednesday, we can look at the graph and see bond prices raise very little as prices fall slightly. This was due to investors seeking more liquidity in a volatile market. The VIX was also up for the day, and there were no new signs of growing economic growth. You can look at Thursday, and you can see there was a reported loss for the week, as investors worry about global growth. There were no more reports released Thursday that talked about economic slowdowns due to no new signs of higher than expected Chinese gross domestic product for the month. Dow Jones dropped 81 points while the S&P 500 only dropped 10 points and the NASDAQ dropped 38 points for the day. You can see as the major composites in the market fall, bond prices generally rise. This is due to investors seeking liquidity when they feel either global economic growth is slowing or no new signs of economic growth are showing. You can look at the graph for Friday and see the projected yields across the bond market are higher. The market had nice gains considering the losses earlier in the week, and prices fell for the day Friday as investors put more money back into the market. The next slide, you can see the yield curve for Monday. As mentioned previously, the 10-year rates, as shown on the yield curve, have a slight leveling off, which shows the influence of the Federal Reserve Bank on those interest rates. As I said earlier, this is due to the 2008 crisis and the defaulting mortgages, and the Federal Reserve Bank is keeping the market inefficient during the 9 through 11 year range. As you can see, compared to Monday's yield curve, the curve steepened. This shows the longer term maturities are rising and interest, which was forecasting. The interest rates have been kept low as mentioned, and you can also see how the curve flattened slightly, and as the forecasted interest rates, the dip shall not be there in 2022, but the yield curve is accurate. This will likely change as the Fed starts pumping less money into the economy and makes the economy more efficient. On the final graph, you see shorter-term bonds saw a drop in projected yields, whereas longer-term bonds saw an increase in projected yields. This was largely due to the increased volatility which drove investors to shorter-term solutions for less price risk. As interest rates rise, prices fall, and longer-term bonds have higher volatility in their prices than shorter-term bonds. This was the reason that the price has risen in shorter-term bonds because investors have sought liquidity and less volatility in the price. As you look at the graph, you can see it looks like a shift from Monday to Friday over to the right. This is due to the Fed's influence on the market. As their influence is taken out and less money is pumped into the economy, you will see the projected interest rates become more accurate in the graph change over the next few years. This funnel graph goes to show that our inefficient market right now is being influenced by the Fed, and if the Fed would decrease their role in the economy, these graphs will become more accurate and we would start to have a more efficient market.